Ladies and gentlemen of the crypto space, we're live on Wednesday, June 14th at 11:45 a.m. Not bad, on time today. How vested interest exits. I want to talk about particularly high net worth, the large vested interest, the folks that have disproportionate over they own the vast majority of supply for one reason or another. Let's start with traditional equities and venture capital and the sequence of events that plays out to understand how you're interacting with these assets as a small actor. $10, $100, $1,000, and even $10,000, probably even $100,000, $1 million, even if you're talking about equities. Those are small actors. So venture capital comes into a startup, they give them $1 million, $10 million, whatever the capitalization is chosen to be, and they own a disproportionate amount of shares as compared to retail, 0.1%. 0.01%, 1%. No, these boys own 25%, 30, 40, 50%, maybe even more. So the whole point of venture capital is you come into a company with $10 million, you increase the amount of revenue the company's making. All of a sudden, the company's making $100 million, and you go to IPO with a 1, 2, 3, 4, 5 to 1 valuation, depending on the market sector. So you go public, $100 million public valuation, and the venture capitalist owns 25%. And so on paper, they turn their $1 million investment into $25 million, let's say, on paper. So what's the whole point of going public is so that that $1 million can turn to $25 million on paper, and that $25 million can be sold to the general public, can be bought by the general public, so the venture capitalist is able to convert that increased in unrealized gains into realized gains by dumping it on the general public, by selling it. There's other ways to behave, but that is not the standard practice for venture capital. You exit. Now, things change a little bit for owners, founders, highly interested CEOs, or insiders that have long-term alignment or want to express that this is where they want to be. And we have to assess this very carefully. This is a topic I've discussed many times, knowing who you're playing with, knowing who the vested interest is. Now, the vast majority of times in small micro caps, especially in the crypto markets, you're talking about predators. You're talking about not even launch vested interest or venture capital type interest. You're talking about an asset that goes live likely in some sort of just minting fashion. You mint 10 million tokens, which takes 30 seconds. I've shown you guys how to do that. And you pair it with $10,000 worth of USDC, and you put it into an LP, and it goes to $10 million market cap. The person, one, who minted the token owns the LP, so they could remove liquidity from the LP, or maybe they did an airdrop and distributed the tokens to other persons, and other persons deposit into LP. Let's say someone owns 25% of the LP, or 25% of the total amount of tokens. They're able to sell them to the liquidity, which is basically dumping them on retail, turning unrealized gains into realized gains. And basically, how much did that cost? How much financing was required to start that? It cost $5,000 worth of USDC in that scenario where you mint 10 million tokens and pair it with $5,000 worth of USDC, and the valuation becomes $10 million. You can see why it's very tempting to dump and exit. Now, that sounds malicious in many regards. It's not necessarily the case. It's predatorial. It's definitely a degree exploitive of persons that don't understand the causality of this behavior, and I'm describing it as granularly and explicitly as I can. Um, and this is what occurs time and time again. And there's nice platforms like bubble maps where you can see concentration of token ownership. And we've seen how horribly disproportionate token capital raises have been, like with the Ben tokens. Whether it's malicious or not, you're swimming with predators with a tremendous amount of concentration of ownership, and the capacity to turn unrealized gains into realized gains is just extremely tempting because it's ridiculously easy, and that's exactly why the token prices have done what they've done. And you have to know who you're swimming with. Bottom line. So there's a couple of different scenarios that emerge, even in corporate America, which is rare. Let's say you're a CEO or a founder of a crypto project for that matter, and you have a disproportionate ownership of a protocol. And there are instances in humanity where you don't want to dump on retail. You don't want to dump on the user base. You don't want to depreciate the price. Maybe you worked years on a company or years on a software protocol, and it's meaningful. Maybe it's perceived as one's life's work, or the significant achievement, or it's just something you want to continue participating in, something that you think is significant for the population as a company or as a piece of crypto software that's meaningful. Now, there's no way from a human perspective to know intentions. We can only construe or kind of indirectly assess the likelihood of intentions. But this goes into like technical analysis where it's like you look for pieces of data, then you look for confluence of pieces of data to support an argument, to support a course of action. So if someone has this kind of sentiment, you want to really understand if the sentiment is likely the case. And what can an actor with this kind of sentiment, this kind of attachment, this kind of opinion of their work do to capitalize? If they sell it, they own a disproportionate amount of supply. They could destroy a community. They could destroy a stock price. They could destroy an entire company because it's all about trust in many regards. And if the founder of a company no longer believes in their product or their company and they just sell all their stock, oh, he doesn't believe in it anymore. He's getting out. He's dumping. There goes the stock price. The small actors that really don't know this kind of dynamic of actor behavior, they're out because they see the price going down, and it just creates that recursive cycle of fear, and there it goes. It's done. So how can you exit, and what is common practice for certain actors in corporate America? And something we don't often see in crypto markets is not exiting. So how do you exit without exiting? You borrow, use as collateral. And my wife talked about a topic last night where a wealthy family bought like a $200 million house, and they bought it in all cash. And I'll give this example, and then I'll go over to the crypto markets where someone did something similar. So if you want to buy a house with $200 million all cash, but you don't want to sell any of your assets and you don't have $200 million in cash, how do you do that? So I was describing this sequence of events. I think this was Jay-Z and Beyonce who did this. And anyway, let me paraphrase the story as best I can. So you obviously have billions of dollars worth of assets and stocks and whatever and instruments and collateral. You borrow $200 million in cash. You buy the house, cash deal. You go to a bank, you get a mortgage on the property because obviously the property is valuable. You use that mortgage to pay back the debt on your instrument or the debt on the collateral that you borrowed to buy the house in all cash. So, and now you have a mortgage. which you service with cash flow. So what did this allow them to do? They didn't have to sell their assets. They were able to use the equity in their assets to finance an all-cash deal, resulting in a net debt position on the property. And this works out because the real estate brokerage probably just wants all cash. They want to settle the deal, get it done, no mortgage, no time, and maybe time was a factor, and so on and so forth. And the whole point is when you have assets, you don't really, and they're productive assets, you don't really give a crap about debt. If the debt explodes, that's often the burden placed on the lender, depending on the protocol. Now, we often talk, funnily enough, in the crypto space, how the whole structure of certain protocols is to place the burden of debt insolvency on the debtor instead of the infrastructure. And I'm not too fond of systems that retain that risk profile, like a bank in an under collateralized debt position. They take on all the risk of the debt becoming insolvent and the debt the interest payments, just insolvency scenario, and that has exists in the crypto space as well. So that's why we focus on protocols that pass the complete burden of debt onto the debtor, rather than the protocol providing the debt or facilitating the debt via their services. Anyway, so in the crypto space, recently, Michael from Curve used his disproportionate ownership of governance tokens as collateral to borrow capital, to access the equity stored in those assets. Now, probably the best way to discuss this topic is what would I do? And me thinking as maybe optimistically, but as someone that would like to think he's highly calculated, intelligent with regard to mathematics, and he sees this as something significant rather than a negative. So this is a decent article with regard to risks to AVE, risk to the curve price with regard to an insolvency scenario where the health ratio, the health factor on AVE gets too low and liquidation occurs, so that would be pretty bad. So what would I do? I would do exactly this process. I would not want to sell the assets. I would want to not make them liquid or increase supply to that degree and dilute people, so I wouldn't necessarily want to even lock them on the platform, because I would have then you would have disproportionate ownership of V-curve protocol transaction fees, and it would just not be in the best interest of the protocol. But you spent all these years of work, so you want to capitalize. So there's protocols that offer lending, and Curve happened to be collateral. So I would say this is the most reasonable choice from a reasonable action standpoint, is to borrow against your collateral. And he capitalized significantly, many millions of dollars, 60, 70, 80, or whatever the hell the total number is. And if you have cash flow that's in the tune of countless millions of dollars, he probably owns a decent sized VE curve position. So if you're making hundreds of thousands of dollars, millions of dollars a year, you make your calculation on how much debt servicing is required to cover, difficult scenarios. Worst case scenario, maybe the curve price depreciates significantly due to other external factors. So the entire prerogative here is to keep the health factor above liquidation threshold. It's never full repayment. It's just about management of the health factor. And frankly, curve emissions in 10 years, 15 years, there's a variety of scenarios where liquidation might not even be too significant. So that's speculative in the future, and based on how this entire thing plays out over the next 5, 10, 15 years, and price appreciation, adoption, consumption, so on and so forth. If you go 10,000x on the money and curve a piece of global systemic infrastructure, you know, it might the market could possibly absorb that kind of liquidation and still remain relatively healthy. Complexities aside from Aave and implications for their protocol and bad debt that it would incur is another story. So they have to make those decisions accordingly. Let's go back to the article. And so there's very much reason for this type of post on Aave, and they're contemplating it from their perspective. And I think that's appropriate. Now, unfortunately, they need to protect their protocol vis-a-vis governance and choices. I think that does highlight, unfortunately, a deficiency in the implementation, which they hopefully have improved with their V3 implementation. But optimally, this type of strategy to capitalize without liquidation should be expected with regard to precedents in traditional finance. This is common practice for large stakeholders in enterprise, insiders, to want to borrow against their collateral, their equity, their ownership of an entity without selling it to the market to disrupt market price or disrupt sentiment toward an enterprise. So I overall think this is quite reasonable. I would like to see the health factor be maintained to a degree, either via repayment as appropriate or recollateralization, upping the collateral as appropriate to be responsible and respectful of the Curve community, as well as Aave. This liquidation would impart a significant amount of bad debt on their community to bear that burden. So that is an interesting consideration. So overall, I would say that this is a healthy type of debate. I think this was a decent practice, a decent method for capitalizing. Maybe there could have been a little bit more expression of restraint. You know, maybe he didn't need it. Whatever kind of house he got, I don't know the degree of accuracy of that story. But who's to judge a person's interests and desires when, with regard to consumption, if that's possible? If you can capitalize that much, not disrupt the community you built, not impart anything significantly negative on the price action, and there's protocols that are lending against this collateral, why is it a bad thing to capitalize to such a degree? So I would probably do something similar to that. So there's a variety of risks to consider from an Aave perspective, from a Michael perspective, from a Curve community perspective, but that's something that we all talk about all the time. What are the risks we're taking? So someone contemplating taking a position should know that these actors are doing these things and there are these risks associated with these positions. How do we manage investments and portfolio? How do we construct portfolios based on relative risk versus relative opportunity? And that plays into position sizing. So overall, I don't have necessarily a negative opinion of what has occurred and what will be occurring for the foreseeable future, because this position isn't going anywhere. I wouldn't repay it. You don't. You want the health factor to remain healthy, and that's all that matters. So everyone will have to proceed accordingly. Aave, Michael, and all the market actors with regard to their risk assessment. And look, DeFi made here depends on what side you're on. It's not good or bad. It's about risk and just understanding potential implications and causality, cause and effect, and what may play out. And that's how this whole game works of capital management. So this is a good article that does concentrate all things that are worthwhile to digest and consider, and to understand everything that's going on. And shit, I'm sure is glad, one, he didn't sell it because the price would have been catastrophically hit. Two, I'm glad he didn't lock it because there would be disproportionate ownership of the platform with regard to governance and revenue and bribe access. So that wouldn't work. So if he couldn't sell it and he couldn't lock it, borrow against it? Great. Would it have been more comforting to see him borrow less? Maybe. Is it bad that he borrowed as much as he did? Not necessarily. All that's pertinent is management of the health factor. So we've seen his choice and decision of what to do. And he decided not to take from the community. He decided not to disenfranchise the community by exiting. The sentiment would have been horrible. That would make no sense. He literally just released a ridiculous piece of software. Tremendous amount of work and effort. I sit here programming all day as an Android developer. I take great pride in the software. It's not my software, it's the company's software. But when I make something, it's very satisfying and elegant to see the code execute as you expected it to. I take great pride in my work, and I would imagine that's very much the case for a lot of people in software. When you do something to be proud of. And I would very much like to think that's the case with these pieces of software. That code is extremely complicated, sophisticated, elegant from a mathematical standpoint. What's there not to be proud of? So what would a person that's proud of what they do, and when you're proud of these types of constructs, you think of it as writing, being an author, or poetry. What would that kind of person do? They would do this. And what would a human do? They would want to capitalize and get access to their money, so they would do this. So all of this seems par for the course. Where does this type of process break down? Excess desire to consume. And that's probably something that's a subjective assessment. Was this excess desire to consume? I don't know. That everyone will have their own opinion of that, and that'll be relative. Everyone will have a different desire to consume to a different degree. But sure as hell was a lot of collateral to acquire a fair amount of capital from. And I know if I would want to consume that quantity as well and do those types of things. So I don't think that was unexpected in many regards. Tap C in the house. Reg domain. Is this a response to Curve and Michael's borrowing against Curve? Yes, that's why I wanted to talk about this and break down the mentality and the decision-making process and why different vested interest does different things. And that's why I started with venture capital and talked about how do you capitalize? What is the whole point of this? And you really need to know who the actors are. And it's not just about this specific topic with Michael and Curve. This is just the various methodologies I discussed. How do you capitalize? You either sell, you lock, which is just you gain access to the cash flow of the business, or you borrow. So now at least we can have a conversation, a granular conversation, rather than just talking emotional or judgmental, and that makes the conversation at least more digestible, and you could be more comfortable and not have uncertainty and fears. We're just being granular. And we've made decent conclusions, likely conclusions. These are the likelihoods of what he was thinking, considering the choices that were available, how to capitalize. Appreciate the dulcet tones of your shared thoughts. I try and be Try and be calm. I do get frustrated at times. There's some insanity, especially that hearing we saw yesterday with the financial committee. Some of those folks were quite unreasonable, and and let's see what happens today with the FOMC. Let's see what interest rates do, and let's see what the market does because this stuff is getting unreasonable. Who knows what's going to happen here? I mean, every either we got implosion written all over the place between student loan repayments and commercial real estate. I don't know. We'll see. Asarco's in the house. And new, no, I feel I'm not maximizing my curve rewards and bribes as much as I should. Can you please share what's the best way to maximize to do this? This is not necessarily a period where maximization is possible. Um, this is a period of austerity, and I've said that since pretty much since 2022, and the numbers have just been going down. I would expect volumes to continue to decrease. I'm curious what happens with CRV USD because that's clearly increasing, swimming against the tide and expanding, and V curve revenue will expand because of it as that governance vote is either up or completing. I think it's completing soon. So there should be an increase in revenue associated with the expansion of CRV-USD. And in a couple of years, I expect that to be quite significant. I expect that to be a significant source of revenue as compared to even bribes necessarily. I don't know how that market's going to evolve, but I definitely see the capacity for uh, dollar liabilities to expand significantly, and that's CRV-USD. Um, so I've max lock, and that gives me revenue from a VCRV perspective, which is relatively marginal. But vote market, staked out as vote market is the only way to maximize revenue, and that means you're breaking down your votes in a very complicated way sometimes, and you have to factor in gas costs. And some of those votes are some of those offerings are relatively marginal. So I could show you here, vote market. All right, we get a little technical. We show off what the hell is going on. So it depends how much votes you have. So, you know, and it depends on dilution. So let's say you have 10,000 curve. 10,000 curve, you can pretty much capitalize on a lot of stuff. Like 10,000 would be less than be 5% of this. So you'd be diluting this 5%. So you'd be getting probably around 750 $700 plus dollars for the week. So 10,000 curves giving you $700 for the week. And as in here, they re-upped it for another 2 weeks. 10,000 curve here dilutes it a little under 20%. So this isn't necessarily opportunistic. So it very much depends on your position size. If you have 10,000 curve, you're probably not going to want to vote for Badger, unfortunately, because you're going to dilute this significantly, and you might have better opportunity even with a lower paying um, rental. So you do have to factor in the amount of votes that you have available. 10,000 curve, you apply it here, it's less than 10%. All right, less than 10%, you're getting $100. So 10,000 votes here, getting less than $100. 10,000 votes here. No, did I really say $700 for the week? I was wrong. It's 10%. You're getting 79. So you have to do those calculations, and it could be a little bit tedious. I never was able to get the optimize function working for whatever reason. Let's see if it actually loads. Asarco, hey, hey, Ashish, Noah, do you think Curve is going to do another all-time high again? Why is that a thought now? I mean, seriously, my friend, now is like the whole world is ending. But isn't that always the conversation about when bottom, when everyone thinks the world is ending? But then again, look, you have the equities market, and everyone thinks, oh, it's the start of a new bull market. And that's where we are. It's like crypto says the world is ending. equities say it's the start of a new bull market, it'll drive you nuts. So this is a period of uncertainty. I, who knows if you're going to see it? And that's not a conversation I'm really too interested in even contemplating. It's irrelevant. You take it day by day. And if you're contemplating from taking a position perspective, an allocation perspective, I think this is not the right market condition to think of allocations. I think you need to wait for liquidity conditions to start to improve. I think that's the best expression of when bottom is when liquidity conditions start to improve. And we see that on the llama, which I have here. I'll digress to this and I'll get back to balancer in a broad market in a second. Stablecoins. I cleaned up my tabs. Yeah, no, look at liquidity conditions. This is not take a position market. This is market is going to continue to depreciate until until they stop going down with regard to liquidity. Stablecoins keep draining. All right. So I opted for three positions considering the amount of votes that I have. And you have to be respective of the amount of votes you have. Otherwise, it doesn't necessarily work out favorably. So overall, I'll probably end it here anew. I don't have the best quick couple of sentences I could say about maximizing your rewards. I think the best way to think about this market is survival. If you're getting rewards, great. Expect those rewards to go down. Expect the curve price to go down, which may indicate there's potential cheaper prices and opportunity, but that doesn't indicate a buying opportunity. You have to look at the liquidity in the market. This is where bottom is seen when liquidity improves and capital starts to flow into the market and you start to see the capital flow cycle play out. So otherwise, directionality continues and prices will get cheaper. Hope that helps. I don't think it helps much, but I hope it helps. So do your calculations, break out the calculator. Anon, I think it's 1.7, whereas health factor is like 1.7. That's the last thing I saw. At a high enough liquidation threshold, it's rational to max borrow and let yourself be liquidated. No. This size of position, it's not rational to be liquidated. It would, based on that article, it would leave Ave with like millions of dollars of bad. It would be bad. It's not good for anyone. It's not good for the curve community. It's not good for him. And actually, it doesn't really matter. It would be a loss of unrealized gains. It's hundreds of millions of dollars a curve, and not that much in dollar liabilities that were borrowed. It would be the loss. So it's bad for everyone. Don't get liquidated, folks. And now also, what do you make of macro boomer markets right now? SPX is pumping. Everything is absolutely ripping from a traditional equity standpoint. Um, I don't. There's contrarian indications all over the place. I don't think this has legs. I think everyone starts to freak out if this thing turns around and rips down towards the TWAP on the 3 month. So I've been looking at this thing on the 3 month. Um, we start to see NASDAQ head towards 306. That's going to change the sentiment real quick. And you're going to see talking heads on mainstream media change their tune real quick. Is the end coming? Is commercial real estate finally exploding? I mean, come on, commercial real estate's going to explode, and student loan repayments are starting again. It's going to be catastrophic for systemic liquidity and velocity, and we keep an eye on M2 velocity, which we have to check back next month for another candle, and that's directionally down. You're not going to see overall conditions improve until M2 starts to tick up. Liquidity starts to tick up, but bear in mind that's also distinct from the crypto markets because you could have concentration of capital, especially from the larger markets to the smaller markets. So even if M2 keeps dropping, if there's some favorable condition in crypto markets, you can see capital inflow, which is why it's important to inspect the liquidity conditions of crypto markets as distinct from traditional financials. Overall, Japan and China have increased global M2, considering this contraction that we're staring at right now. Europe contracted their overall dollar liabilities as well, but Japan and China accounted for that, and total liabilities has increased, has never decreased. Um, so that's considerable. And you got to remember, crypto markets are a global market, so you could easily see capital inflow from other parts of the world, dollar denominated, even though you have a contraction in liability supply in the US. That's not unreasonable. So this is a great page, and DeFi Llama nails it with the stables page, and this tells us what we need to know when we start to see positive sum game. This is a negative sum game, and that is not a market that's your friend. That's a market where things depreciate, entry prices will get cheaper, velocity will decrease, which means revenues from the enterprise that you own will decrease. I look forward to that story changing, but that is the current story. Um, Madness. I thought the protocol was made to use like this. Well, yes. Software does not specify how it is to be used, so therefore it was used like this. Therefore, it's designed to support this functionality. And they're responding accordingly with regard to governance, and that's fine. So overall, I don't see too much of anything that is overwhelmingly discomforting. Protocol dev sell token equals bad. Protocol owner don't sell token equals bad. Yeah, it's always bad. You know, everyone looks for a reason to FUD. But I like this narrative that we talk about currency recyclers and modeling on traditional sovereign financial systems, and I think it's fascinating what has emerged. And there's like three or four currency consumers uh, protocols that are launching that are going to put Curve in reserve. You know, what, Prisma, Curvans. There's another two of them, and I find that fascinating. And we've seen the infographics of the Curve ecosystem. It's big. I think I could find that real quick. Let's show that infographic for the fun of it. It's somewhere here. That is a heck of an ecosystem. That's meaningful. Convergence is another one coming. Curvance, Prisma. So it's all here, all the new ones as well. I'm not. I tend to be optimistic. I tend to have faith when it's appropriate, or have a favorable opinion when it's appropriate. And to me, this is meaningful. I'm not. How could you argue this isn't meaningful? Look at all these people behind these protocols. Are countless people that are. This is a good part of their life. So that's meaningful to me, and that gives me a good opinion of what's occurring. Period. Uh, One curious view, Shisha. Do you regret locking for 4 years? No, this is what I've done. I've told the story for the last 2 years of why I do what I do. This is I'm I relock every 2 weeks or every month, depending on conditions. I up the lock. It is not a position. I made a purchase, and therefore I get to relax on a daily basis, not even contemplating, oh, can I sell? Do I buy? What do I do? No, I own this. I own I own this. This is all I have. I have this and I have this. I get to go here once a week and click the dashboard button if it ever loads, and I get to click this claim LP rewards button. I get to click this button once a week, and I get to go here once a week or Warden, depending on what kind of opportunities are available. I purchased that right. I can't sell it. So that was my choice, and I'm quite comfortable with that. And now, in 5 years' time, 10 years' time, I'm going to be able to go to that page, and I'm going to be able to claim money. And that's what I wanted to do. And you know, I'm very much comfortable with that decision. Anon, there was a good Blockworks interview with a former Fed president named Robert Kaplan, who predicted stronger than consensus economic growth due to the mandate that local governments use unspent COVID. Well, that's increasing liquidity. If they're spending, that liquidity is entering the system. And right now, like bank deposits, if the general public has a half $1 trillion sitting in bank deposits, that's and they spend it, that's increasing the liquidity in the system, increasing velocity, increasing capital flows, increasing productivity, so on and so forth. Or is a driving force to increase productivity because now more goods and services need to be manufactured, so on and so forth. So, that's just part of the equation. It's very hard to pin down what's going to happen from a macroeconomic perspective because there's so many moving parts. I mean, look, student loan overpayment, there goes everyone's money. Everyone that owes student loans is going to be broke again. Commercial real estate could just evaporate 60, 70% of all the on paper value of the commercial real estate. And that's capital destructive. There goes liquidity. The capital raise of the Treasury, in theory, could dry up liquidity if money from circulating in America is used to buy that debt. That'll dry up liquidity. If the money comes from overseas, that's another story. That dries up international liquidity. If the money comes from the RRP, that's kind of just a wash. Albeit this chart does indicate something very interesting. Not move here. This chart indicates, because it includes the Treasury, this includes the amount of money that's draining from the RRP isn't going to the Treasury. So this is a pretty good representation of domestic liquidity conditions, not overall liquidity. USM2 is overall liquidity, but this is like liquidity conditions, liquidity pressure maybe. I wonder what Arthur Hayes would say to that, because it's not just the amount of liquidity in the system. That's clearly M2. I think we would agree with mostly what I'm saying. So Fed balance sheet minus reverse repo minus Treasury. So maybe the purchases from the Treasury capital raise haven't entered the TGA yet. I don't know. But overall, liquidity conditions have been increasing. Liquidity pressure, as per what this chart represents to a degree. Obviously, the chart's up. So I don't know. There's contradicting macroeconomic forces that are very powerful all over the place. Improving liquidity conditions, the threat of commercial real estate and student loan debt. The Treasury capital raise is going to be another trillion. Where the hell is it going to go? It's very interesting. So, as Luke Roman says, let's watch. Unlike many other folks that are fearful, I'm like, let's watch. Let's watch. This shit's going to be fucking crazy. And the place that I want to be is front row and center. I want to see what the hell is going to play out. I want to have my foot in the game. Is that the phrase? I want to have these positions that I have. I want to see what plays out. This shit is crazy. We're talking about real life here for countries and the populations of the countries. This is big stuff. So I'm in the right place. It's the right time, and I'm along for the ride, and I like it. Raul, how are you? Pleasure. Danny, dumb question, but how do you claim rewards weekly, or do they accumulate? So very important thing to note for folks that have no experience. You have to claim. You don't have. This accumulates. So this is marginal. This is like 1, 2, 3, 4, 5%. You're getting peanuts. I happen to get a little bit, like 200 something, 300 a week. Listen, and I'm very hopeful this goes up significantly, and I think it will for a variety of reasons. Anyway, aside from what I make, on staked out, you have to claim weekly. Don't forget to claim weekly. You will lose your money if you don't claim weekly. This you have to claim weekly. So be considerate from a gas perspective. This does not accumulate at all. Warden accumulates. It'll accumulate here, and you don't have to claim weekly. And for the first time in maybe a long time, I haven't claimed. So I'm just letting some claim just sit here, because if I claim, then I have to do my accounting and report it as income, and I don't necessarily want that income. If I finally expect the price to go up, it's come down so significantly, I don't need to claim for a variety of reasons, so I'd rather hold it unclaimed and avoid taking that income distribution now, so to speak. King, what do you think about Pendle's duration vault for LSTs? Off my radar. I'm not interested in Pendle. There's a lot of stuff going on. Maverick is interesting. Um, I am very interested in the direction I'm seeing things head with these LSDs or LSTs in general. Um, I think the capacity for capital expansion in the crypto markets is extraordinary. I think the capacity for the crypto markets to print dollar liabilities is extraordinary. We'll see what happens. There's a lot of moving parts and there's a lot of protocols. And what I know from humanity is if you build it, they'll use it. So these systems are being refined, they're being enhanced, they're being iterated, and they're very powerful from a credit perspective, from which has a capacity to manifest significant velocity. And I'm not even talking about speculative. I'm not talking about derivatives exchanges and gambling. I'm talking about credit, which is needed from an enterprise perspective. So you got to remember, folks often can talk about the gambling perspective of crypto, and literally I sit here screaming about enterprise business, the pizza shop down the block. If they can't get a loan from a bank, but the owner happens to have 200 grand worth of Ethereum because they're an investor, and the bank's like, no, we can't loan you right now. Maybe their balance sheet doesn't have the capacity, and they can't get their small business line of credit, and they need their net 30, net 90 capacity. Oh shit, the owner has 200 grand worth of Ethereum, but they could get an instant loan from a variety of different sources in the crypto markets. Oh, all of a sudden that person, that owner, has a capacity to get the credit he needs permissionlessly. So that's the significance of the crypto markets that I see. It's actually from an enterprise, a real world enterprise perspective. Credit, liability printing. This is big financial shit that has nothing to do with fucking gambling. I'm tired of that narrative. Gambling. This is not about gambling. This is about real world financials. Even Bitcoin fits in that category as a collateral. And, we won't digress too much on Bitcoin, which is probably an interesting topic for an entire stream because I have a high opinion of Bitcoin. I'm not too fond of a lot of the circulating narratives, but I would discuss it from the perspective that I'm fond of. Koji, trying to understand vote escrow. If I put 10K into a curve pool, do I need to lock equal value? Oh, goodness gracious. You providing liquidity on curve and having VE curve, you need millions of dollars for it to be even remotely profitable. So that doesn't work anymore. That worked maybe when Curve was launched. It did work when Curve was launched with, 5, 10, 15, $100,000. We were able to make some nice returns on the gauge boost. Now, if you're providing liquidity, you might as well go to Convex. And even on Convex, if you're getting 10, 15% on your money, you're going nowhere slow. So over the years, I've learned that providing liquidity is just it's not profitable. I mean, if you have hundreds of millions of dollars, you're a billionaire and you have an extra $100 million and you can get 10, 15% in crypto markets, and fine, that's cool if you want that risk profile. I mean, 15% compared to 5% on gov debt, that's quite palatable from a $100 million perspective. So that's the LP reduction as I see it. You're not don't even waste your time. Us folks that have been around for a long time played around with LPs until our eyes are bleeding, and we've talked about LPs. There's other types of LP opportunity. Depends on your size always. So don't waste your money on transaction fees, Koji, with LPing. Unless you have, maybe you're one of the rare viewers of my stream that has a couple $100 million sitting around. I'm not judging. Dopamina, hey, I wish I can lock curve, but I'm concerned how fast DeFi grows. A permanent lock seems precipitate. Not worried about other protocols stepping in. Listen, this is not up to me. You have to assess if you're worried about other protocols stepping in. Of course, new protocols could step in, but we've discussed concepts of lendiness. We've discussed concepts of those in the lead remain in the lead. Apple has never disrupted Microsoft. Apple disrupted other markets, but Microsoft owns business. They own business software, period. Microsoft Office products, that owns the market. Apple has zero share of the business sector. So Lyft never disrupted Uber, but obviously Apple and Google disrupted BlackBerry and Nokia, and Uber disrupted the taxi industry. So, these are complicated considerations that play into your risk assessment and should play into your position sizing. And we've talked about other considerations like excess diversification, you miss opportunities. Excess concentration takes on additional risk, but that's how you make money. So there is no simple equation to all of this. And all I can do is explain to you the story of how to make these choices and hopefully make them a little bit better than you would if you didn't know all the nuances to the story. Shisha, are you considering a CVX position? In this market, you know what I'm considering? Vacation. I'm considering, I have taken one position this year. That was that Aura position, which worked out well. Or maybe I took it late, end of last year. And at this point, I'm contemplating liquidation. At the end of the month, I have another 2 weeks. It's done well, and I believe in the direction they're heading from a federation perspective. Balance of V2 is easily setting an example for like even Uniswap V4. So that's big stuff. It's absolutely very awe-inspiring what the hell's been going on in the Balancer and Aura governance forums. The amount of iteration is extraordinary. The amount of progress they've made, not just from a software perspective, but their capacity to actually make decisions as a governing body is quite interesting. So that is something that encourages me to not liquidate and just I get the revenue. Aura pays. It adds up. There's a claim from Aura. I got a couple hundred there. And Aura pays from its vote rentals on Hidden Hand. So the numbers have been going down. I expect the numbers to go down. It's quite disappointing at this point in the 3 cent range, but it is what it is. So, this is a time to be humble. This is a time to be appreciative of what you have. And it comes back to like a very common argument, hodlers and should you sell? You shouldn't hold on the way down. And clearly that makes no sense from a financial perspective. Something's depreciating and you're not capitalizing, you're losing out on those unrealized gains. But this stuff produces cash flow. And if you restructure, redefine this behavior as a purchase rather than a position, stop staring at the value of the position and focus on the amount of cash flow it provides. You bought a business. Maybe you never knew you could buy a business, but if you own these types of positions, I would define them as businesses. And does the business succeed? Does the business fail? That happens all the time in traditional finance. I happen to think these are absolutely extraordinary businesses. And once a week you get a payment, get income from your business. And that income is going to vary depending on market conditions and the directionality of the market. In several years, we expect the revenue from these businesses to significantly increase. So that's a nice speculative undertone. But you don't speculate, don't have that potential excitement right now about the future in these market conditions. These are fucked up market conditions. These are market conditions where you should be afraid. You should be hesitant to deploy capital. And you should be relying on, hopefully, rationality. Data, be quantitative. That's why we look at liquidity to assess, is it a negative sum game? Investing in a negative sum game should expect depreciation. Hope that helps. Koji, you're welcome. Size is definitely not size. Listen, some of you guys see my size. My size isn't size. So that really should give you perspective. I literally you have to respect your size. I don't have weight compared to big actors. And obviously that's relative. Persons with 5, 10, 15, 20 grand, I have weight compared to that, but I don't have weight compared to someone running around with 100, 200, 300 mil, even someone with 5, 10, 15, 20 mil. So it's all relative, and it'll drive you nuts. And you can't compare. You can't play someone else's hand. You have to play your hand. And someone that has a 10 grand portfolio is looking at my portfolio and is like, oh man, that's a huge amount of money. And look, I sit here every day and I look at portfolios that have 20, 30, 40, 50, 100, 200, a half a bill, and I'm like, oh man, I got no size whatsoever. So just remember that. It's all relative, and there's always someone with a bigger bag. Buddy, hey Cap, I remember you said you kind of like Polkadot. How do you think in position right now? I don't know. Polkadot, Cosmos, everything other than Ethereum mainnet. It's kind of same category right now with regard to where the hell it's going to land. Yeah, I've had a Polkadot position since before the 100-to-1 reverse split. That was a long time ago at this point. And I have an Astar position from a Plasm lock drop, which is worthless more or less. But that's it. That's the extent of exposure I have there. That Astar position is worthless. Nothing compared to what it was. And Polkadot, we'll see what happens. It'd be nice. I think it's interesting what they tried to build. They tried to build something along the lines of a network of blockchains, which is what Cosmos hubs are. So we'll see. We'll see. Let's watch. Listen, that's important. Let's watch. It's important to understand you have no idea what the hell is going to play out. And let's watch. I want to watch. I want to be on the front row seeing what the hell plays out. And I want to have some skin in the game to see what plays out. Because this shit is interesting. Much more interesting than almost all traditional enterprise, aside from the little things that I've discussed that I allocate to over the years. One curious view, I feel mainnet is not for small size anymore. The L2s will be dominant. Okay. I'm going to try and wrap up soon, but this is an interesting point. To a degree, yes, because it's expensive. So you're forced out on the risk curve to engage in like the L2s and the Alt L1s, and that's okay. The narrative for the Alt L1s and the L2s is not the same as mainnet. If hundreds of billions of dollars or trillions of dollars or a country wants to deploy its sovereign debt, they're going to deploy on mainnet. They're not going to be deploying anywhere near the Alt L1s or the L2s, in my opinion. And that's obviously expressed with the amount of dollar liabilities that are on mainnet. That's where the dollar liabilities are. This plays into the notion of those in the lead remain in the lead, lendiness, so on and so forth. So you make an interesting point. And that's a reality for smaller portfolios. You tend to have to be more concentrated rather than diversified. You tend to have to take on more risk rather than less risk in order to grow the portfolio. Charlie Munger says you get your 100 can however the hell you can. Get rid of your house, get rid of your car, take the bus, sleep down underneath your desk at the office. You do what you have to do. So, and I guess I'll end on this note with regard to smaller positions, smaller portfolios. It's not easy. And I remember my days with smaller portfolio. It was very frustrating and not easy. And there's nothing certain in life, and you do the best you can. And I bring you back to the most important thing. Be rational. And rationality will help you make the best decisions possible. And emotions are almost irrelevant in this business, in the calculations you have to do to make better choices. Are you still picking up NFTs? Hell no! I didn't even get any llamas. I'm not in a position to really spend any money. I have, I think mostly with regard to capital from my family's resiliency standpoint. Do I have enough capital? If I continue to bleed from a cash flow perspective, what kind of savings do I have? So I'm not in a cash spending mode. I'm in a cash retaining and saving mode. And I don't save necessarily in cash. I have assets. Vast majority of my savings right now is denominated in Ethereum for what it's worth. Um, I have a couple. I won't. By the way, I won't be here next week. I'm going on vacation, talking about cash saving mode versus spending. But I had that vacation booked for 2 months, and cash flow was better 2 months ago. Shisha. But if business costs more than it produces, what to do? But the business in crypto has zero capex, no human resources, no benefits, no real estate. There's no capex at all. So, food for thought. And that's why I'm absolutely fascinated by crypto enterprise that provide actual financial services. And there's another last note, and there's another part of the equation of assessing enterprise in crypto markets. There's the balance sheet, and if you're allocating to a crypto enterprise, you want that balance sheet to be sustainable, positive. They need profit. It needs to grow, and hopefully that profit is distributed to its owners, us. This intermediated positive cash flow. There's another story with stuff like Curve and stuff like Aura and Balancer and the other currency recyclers, the solidly forked, so on and so forth, that operate at a perpetual deficit. That's a nation state. That's literally like the U.S. federal government, or any nation state for that matter. Well, mostly the U.S. federal government, because it is a deficit nation. We have to run constant deficits, or we run constant deficits. So, and you need other countries to sterilize the bond issuance. So that's the federation. So that's quite fascinating. So from a balance sheet perspective, an inspection perspective to assess the viability of a crypto enterprise or how healthy a crypto enterprise is. For the vast majority of systems, you're looking to traditional enterprise where you want to see positive cash flow. And other protocols, because this isn't the equities market and traditional corporate America, we're talking about the crypto space here. There's other types of financial regimes that have been created that are modeled very much more so like nation states, and very much specifically like the U.S. as a deficit running nation state. And federations are consuming and sterilizing the excess supply in the markets, much like the world has done since 1971 with U.S. treasuries. So I find that comparison very compelling, very interesting. All right, let's wrap it up. 31 people towards the end of the stream. I appreciate all of you. 10 likes. Hit that thumbs up button. Wednesday, June 14th, 12:48 p.m. I appreciate all of you. Tell everyone to subscribe, and I will see you again on Friday after party on Discord for the most rational community in the entire crypto space. Have a good one. Peace.